Today we're doing something practical. Case studies of capital raises for small and mid-sized businesses. Not theory, not buzzwords. Realistic scenarios. What worked, what went sideways, and what you can steal for your own raise.
And we'll keep it balanced. Because raising money can sound like a victory lap, but sometimes it's a slow-motion problem you don't notice until 6 months later. We'll look at good outcomes and the kind that quietly create pain. Bad terms, misalignment, or just the wrong amount of cash.
Quick note, we're not naming real companies. These are composite case studies based on patterns we've both seen. Bank deals, investor rounds, and everything in between.
All right, let's start with a clean win. Case study 1. A light manufacturing business doing about $12 million in annual revenue. Profitable, but lumpy cash flow because they buy materials up front and get paid later.
Their problem wasn't we're losing money. It was working capital and capacity. They had purchase orders they couldn't fulfill fast enough because their equipment was a bottleneck.
So they explored equity at first. A couple of investors showed interest, but the owners didn't actually want a partner making strategic calls. They wanted speed and control.
Which is a huge self-awareness moment. They went with a senior secured bank facility, a receivables line plus an equipment term loan. The keys were 1. Clean reporting. 2. Strong customer concentration analysis. And 3. Showing the bank that new equipment shortened delivery time and reduced rush costs.
And they didn't just ask for money. They presented a capital plan. Here's the equipment, here's the vendor quote, here's the installation timeline, here's how throughput changes, and here's the staffing plan.
The result? They raised $2.8 million total. $1.6 million revolver tied to receivables, and $1.2 million equipment financing. No dilution. The covenants were reasonable because the business could demonstrate consistent margins and had a credible monthly close process.
Lesson 1. The best capital raise is the one that matches the problem. If your issue is working capital timing, equity is often a blunt instrument.
Also, your capital story matters to lenders too. Banks don't invest based on dreams, but they absolutely care about the narrative of risk reduction. Better throughput, fewer late deliveries, tighter cash conversion.
Now, case study 2. The growthy service company that raised equity and it went, mostly well, with a few scars. This one's a multi-location home services business. Think vac, plumbing, electrical, around $6 million revenue, strong demand, and a clear acquisition opportunity in adjacent towns.
They wanted to buy 2 smaller competitors, plus invest in marketing and a better scheduling system. They tried traditional bank debt, but their historical financials weren't clean enough. Mixed personal expenses, messy add-backs, and a weak handle on unit economics by location.
So they pursued a minority equity round. $3 million from a local private investment group. The good part, the investor brought operational help and a recruiting network. They professionalized the back office quickly.
But here's where it gets interesting. The company accepted a structure with participating preferred returns. In plain language, the investor got preferred return and then also participated in additional upside. That could be fine, but for a mid-sized founder, it can quietly change the math of what you think you own.
Exactly. The founder was focused on the valuation number. We got an $18 million pre-money. But didn't model the exit waterfall. At a modest exit, the investor's economics were way better than the founder assumed.
The upside is the company did pursue acquisitions fast. Within 18 months, they doubled revenue. But the founder later felt trapped. More growth meant more capital needs, and each round risked compounding preference stacks.
Lesson 2. Don't negotiate just valuation. Negotiate the whole deal. Preferences, participation, anti-dilution, board control, information rights. Those things define your future options.
And if you're thinking, that sounds too technical, that's precisely why you slow down and build a model. If you can't explain your own cap table outcomes at 3 different exit prices, you're not ready to sign.
Okay, case study 3. The raise that was successful and still turned into a mess. E-commerce brand, about $4 million revenue. Low profitability because they were spending heavily on paid ads.
They raised $1.5 million on convertible notes. Fast and easy. The pitch was new product line, better inventory buys, and once we scale, margins improve. A common story.
Here's the issue. Their primary risk wasn't lack of capital. It was customer acquisition cost volatility. When ad costs increased, their unit economics collapsed. Inventory piled up, cash got trapped, and the note maturity started looming.
They had assumed they could raise the next round before the notes came due, but the market cooled, and they couldn't show profitable growth. Now they had lenders in waiting, note holders, who could pressure the company at the worst possible time.
They ended up renegotiating, extending maturity, increasing interest, and giving additional warrants. More dilution, but also a signal to new investors that the cap structure was getting complicated.
Lesson 3. Fast money is not free money. Convertibles can be great when you truly have a near-term inflection point. But if your fundamentals are still unsettled, you might be borrowing time at high cost.
And a practical tell, if your plan is basically we'll raise again, that's not a plan. A raise should buy you a milestone that stands on its own: profitability, repeatable sales playbook, churn reduction, or a signed contract base.
Now, let's do a turnaround flavored case. Case study 4. A B2B software company, more like a small SaaS, doing 2.5 million ARR, decent retention, but they'd overhired. Burn was high and runway was short.
They went out to raise equity at a high valuation because that's what they remembered from the last boom cycle. Investors weren't buying it. Not with those expenses.
Instead, they did a structured raise, a smaller bridge round from existing investors, paired with an aggressive operating plan and a revenue-based financing component tied to collections. Not a perfect fit for every SaaS company, but it worked because their revenue was relatively stable and gross margins were strong.
The good decision was humility. They raised less, only what they needed for 12 months, then hit specific milestones, reduce burn, improve net retention, and show a repeatable outbound motion.
Lesson 4. Sometimes the best raise is the one that forces focus. Overcapitalizing can hide product problems. Undercapitalizing can kill you, but right-sizing around can sharpen execution.
Let's switch to a classic small business scenario. A family-owned distributor trying to fund a transition. Case study 5. Distribution company, 20 million revenue, thin margins, strong relationships, but the founder wanted to retire. The next generation wanted to buy out ownership gradually.
They considered outside equity, but that would change the culture and likely push for aggressive cost-cutting. Instead, they used a combination: seller financing, a bank term loan, and a small SBA-style structure for part of the transaction.
The good here was aligning capital with goals. They weren't chasing hypergrowth. They were managing succession. The bank loved the stability and the tangible inventory, but required much tighter inventory controls and monthly reporting.
Lesson 5. For many mid-sized businesses, capital raises aren't about expansion. They're about transitions, ownership changes, buyouts, partner exits. The right capital stack can preserve the business while respecting the people involved.
Now, we should talk about a bad raise that happens all the time: raising too much too early. Case study 6. A local food brand expanding into retail. They got an enthusiastic angel group, raised 2 million, and immediately scaled production, hired a big sales team, and signed a costly co-manufacturing agreement.
But their product market fit in retail wasn't proven. They had some early wins, but velocity per store wasn't consistent. Returns were high. Promotions ate margin. And suddenly they had fixed costs built for a business they hadn't become yet.
The painful twist is that raising money created urgency to spend it. Investors wanted growth, the founders wanted to show momentum, and they skipped the slower work: shelf tests, channel strategy, and replicable demand.
Lesson 6. Capital doesn't replace validation. If the business model is still experimental, a large raise can scale the wrong thing.
Okay, so across these case studies, what patterns show up? Let's make it actionable. First question any owner should ask: what exactly is the money for?
Working capital, a one-time asset purchase, acquisitions, hiring, long sales cycle bridge. If you can't name the use of funds in one sentence, you're going to get mismatched capital.
Second, what's your risk profile? Lenders want visibility and collateral and stable cash flow. Equity investors want upside and a believable growth engine. If you pitch the wrong audience, you'll either get rejected or accept bad terms out of desperation.
Third, build your downside plan. What happens if revenue is 20% lower than forecast? Do you still survive? What do you cut? How fast can you cut it? The best raises we've seen included that plan right in the conversations.
Fourth, understand the control implications. Debt usually comes with covenants and reporting. Equity comes with governance. Convertibles come with future dilution uncertainty. None of these are bad, but each one changes how you run your company.
And fifth, get your materials and metrics tight. Not glossy, tight. Clean financial statements, clear customer concentration, cohort, or attention, if relevant, a sensible forecast tied to drivers, and a real timeline for the milestone you're funding.
Let's end with a quick if you're listening and you're about to raise checklist. Pick a number. What would be a responsible amount to raise if everything goes right? And what's the minimum you need if things go okay but not great?
Then ask, how long does that money buy you? Not in months of runway alone, but in progress. What must be true at the end of that runway for you to have more options than you have today?
And finally, model the deal. If it's debt, simulate covenant pressure. If it's equity, build the cap table. If it's a convertible, run multiple conversion scenarios. If you can't model it, you can't manage it.
That's the episode. Case studies, the good and the bad, with one big theme. The best capital raise isn't the biggest headline. It's the one that fits your business and keeps your options open.
Next time, we can go deeper on one topic people ask about constantly: how to prepare for diligence without losing your mind or your momentum. Until then, take care and raise smart.